Howdy, everybody. Welcome back. This is 5 Minutes with Five with Eric Bratcher. The last time we spoke, it was just before the winter. It was prior to November. There's been a lot of stuff that's happened this winter, and I want to cover it all. So this is going to be quick. Buckle up. Let's go. All right. So in November, we were showing a decent amount of cold weather coming. That cold weather that came in November forced a decent amount of price volatility in the natural gas market. You saw a nice run up in this winter's prices. It was followed up with a very mild December and January, kind of crushed prices. Then the return of the polar vortex. The polar vortex came at the very end of January. We saw some of the coldest temperatures we've seen ever in the United States. We had the largest consumption of natural gas by both consumers and residentials on January 30th, only beat by last January's, I think it was January 4th of 2018. So massive draws on natural gas. The short story is price volatility just didn't happen. The max prices that we got in the Northeast was $10 to $12 per MCF or $12 per decatherm compared to $140 that we saw the previous year. So prices kind of fell flat this winter as far as those daily spot prices, the thing that kind of drives all that price volatility. The Midwest was even a better picture for consumers. The high prices that we saw on those coldest days in late January when Chicago was negative 27 degrees was no more than $5 to $6 per decatherm in the city. So not that bad, not nearly as bad as what we've seen. That's had a nice effect for buyers in the rest of this winter. Natural gas prices for this winter have really cratered. The March contract is trading at its all-time low. So if you're still short gas for March, there's a lot of good price signals there. Now let's look at the impact that this winter's prices have had on the futures. The Q1 natural gas prices, this kind of stuff that we're through with, obviously settled low in the spot markets. Q2 has had a little bit of depression, but the rest of the curve, Q3, Q4 of 2019, and pretty much everything beyond it is not really seeing any depression. The NYMEX, or the national average for natural gas prices for those outer years, are actually trading up a little bit. The only real nice price relief we're seeing is the winter of 2020 and the winter of 2021 in the Northeast and the Midwest. Those have seen a decent sell-off because of the lack of volatility that we've seen here this winter. So kind of double-edged sword. Lower winter prices in the Northeast, everything else is kind of trending upward. So let's jump to regional. In the Northeast, New York and New England. New England just finished their capacity markets that settled way below expectations. That's good if you still have open positions beyond 2022. New York is pushing forward with the Clean Energy Initiative that is going to be implemented in late 2022. That's seeing a lot of upward pressure in prices for those outer years, with the front half of the curve still being quite depressed. Moving on south, Pennsylvania is pushing forward with their own version of zero-emission credits. You should start to see this. Exelon is the largest nuclear generation holder in the state of Pennsylvania, and they're pushing really hard to get something on the books by May. They're threatening to retire 3 Mile Island if they don't by the end of the summer. So a lot of regulatory pressure in PA to move forward with a zero-emission credit, just like New Jersey, New York, and Illinois. Moving on to New Jersey. New Jersey just passed their default utility rates. You're seeing a marginal, maybe not marginal, depending on if you're in the state, increase in prices across the board for all rate classes. A lot of this is driven by the new renewable mandates in the state. And those new renewable mandates are even offset the fact that capacity cleared lower. It's kind of raising all retail prices in the state. So sorry about that, New Jersey. Moving on south into Texas, the PUC, the Public Utility Commission, has recommended to ERCOT to implement a change in how spot prices are developed. And it's really what causes the spot prices to increase at the times of scarcity. They're going to implement that in stages, the first in this summer and again in next summer. So we're going to see that in stages, but that in concert with an ever decreasing reserve margin has a lot of fear in the state price-wise. So you're seeing a lot of increased prices, that increased probability of high index prices is really pushing up forwards for this summer, really through like 2024. So if you have a contract that expires in any of those time frames, you're likely seeing sticker shock on those retail offers. Talk to us. There's some things we can do to help with some of that. Okay, guys, I know that was a lot of stuff going on, a lot of volatility, a lot of regulatory changes. In addition to the normal market updates we normally produce, we're also having the upcoming webinar, the end of the winter webinar. We're going to go back over a lot of this stuff a little bit more in depth. And in order to give you that in depth, we're kind of breaking this up into 3 different regional calls. We're going to have a New England, New York regional call. We're going to have a Midwest and Mid-Atlantic and a Texas. So we'll talk a little bit about natural gas in all three because natural gas is applicable to all three. And then the individual market, the regulatory changes, the thing that are driving each of those individual markets. Look for that invite. It should be coming soon, and love to see you there.